Hey there, here's a quick note. This podcast contains general financial advice only. That means it's not specific to you, your needs, goals, or objectives, so don't act on the information until you've spoken with your financial advisor. You'll find our full disclosure, disclaimer, and link to our financial services guide in the show notes.
Hi there. In this episode, I chat with Bob Desmond of Claremont Global about his investing journey spanning across his home country, Zimbabwe, to London, and now Sydney. Bob provides an in-depth overview of the investment process at Claremont Global and demonstrates this through a lot of global names. I gained a wealth of knowledge about the importance of quality businesses and management teams when undertaking a high conviction investment approach. It was also an important reminder of honing one's attitudes, skills, and shortcomings to become a better person and human being. I hope you enjoy this episode. Welcome to the Australian Investors Podcast, Bob. How are you going?
Morning, Ray. I'm good. How are you going?
Yeah, good. So you were born in Zimbabwe, and I noticed there are 16 official languages. So what did you speak?
I speak English. It's the official language. And then there's probably two other main languages, but then lots of subclans, Shona and Ndebele. Shona is the kind of majority, and Ndebele is kind of descended originally from Zulus in South Africa. But I speak English. Yep.
Okay.
And a little bit of French.
Okay, very interesting. Any reason why you were interested in French?
I lived for a year there in France when I was younger. I wouldn't say it's that good now. As judged when I go to Paris, I give directions to taxi drivers and end up in the wrong parts of Paris. But yeah.
Great, that's fascinating. So what was it like growing up over in Zimbabwe, and were you into investing from a young age?
I wasn't actually. I was kind of always interested in shares because, my stepfather was kind of very interested in shares, and so was my dad. So that sort of initially piqued my interest, I guess. And I've always been interested in newspapers. I mean, I remember being at boarding school, and I just couldn't wait for the newspaper to arrive. Which is a pretty poor newspaper in Zimbabwe, to be honest, mainly government propaganda. But I always was interested in just newspapers and history. And I guess growing up in Zimbabwe and Africa, politics was always very topical. But yeah, I didn't start investing, really seriously until my mid-20s.
Okay. Yeah, on the newspaper topic, was it a monopoly in terms of, was it one just...
Yeah, there was two main newspapers, the Herald and the Chronicle, both full of government propaganda. It was quite interesting when I was at boarding school. The newspaper would have the sporting. The first thing I looked for was the sporting results from the Premier League, because I was a big supporter of Liverpool. Bruce Grobbelaar was Zimbabwean. He used to play for Liverpool, but those would be like 2 or 3 days out of date when I got them. So yeah, it was always the sport I looked at first, and then the business pages, and it's pretty much still the same today. Yeah.
Okay, great. Were there any particular businesses that really, struck out when you were looking at the newspaper, reading over it, and thought, "Oh, I might put some of my hard-earned money from a young age"?
No, I only really got interested, like I said, in shares in the mid-20s. Yeah, and it was quite interesting though in Zimbabwe that there was very little competition. So it was a lot of the industries were controlled by foreign sort of conglomerates, and they had monopoly positions. Industries like beer or banking or a really good company called Seedco or fast food or. So I always thought those were anything consumer related. And brand right from an early age, consumers, brands. I was always really interested in those types of businesses. And then, from never really that interested in mining and, capital intensive industries. Just right from the word go, just didn't appeal to me. No.
Okay. So moving forward into your 20s, so are you able to go through, what it was like trying to get your head around investing and trying to learn about the industry?
Yeah, so I went to university, funnily enough, in Australia, and I did a politics and economics degree, and I found the politics really, really interesting, though I couldn't really see how I was going to earn a living from it. And then the economics, the microeconomics, I found incredibly boring. But the one subject, I think it was the only subject I got an A+ for at university, was the rest were very average, I'm afraid to say, was international finance. And I always found that really, really interesting, markets and international finance. So I went back to Zimbabwe. I spent 1 year in advertising and decided that wasn't really for me. And so then I actually started in money markets, funny enough, not actually in the stock market. So my first year or two were actually in money markets, dealing for clients on, buying treasury bills, NCDs, that type of thing. And it was quite an interesting time in Zimbabwe then, because the economy had been really controlled and was just starting to open up. If you remember back in the day, you had the IMF, World Bank reform programs, which were big in the 90s. And it was really interesting because we'd always had negative real interest rates, and interest rates have been controlled by the central bank and the government. And so they'd let interest rates be real. And, when I started, I think interest rates were around 40%. And inflation was, let's say, 20-25%. So you were earning a really high real rate of return on money. And it was my first kind of instance of how changing interest rates can be really dangerous to an investor. Because what happened over the subsequent couple of years, interest rates went from, call it 40% down to 10 or 15%. And so investors saw their incomes dramatically reduce, but it wasn't as if the cost of living had gone down. It was just going up less quickly. So that was my first instance that, investing in cash, it's actually not really that safe, because your income stream is so volatile. So that was a really, that was probably the first lesson I got. And obviously there were big swings in inflation and got much, much worse later. But that was my first job in markets in Zimbabwe.
It would have been a very erratic time. So how did that affect your psychological mindset, like your view on the future of markets? Because I'm not sure if you've read Psychology of Money by Morgan Housel. He often says people are often shaped by their experiences early on, and that dictates their view on the world and the future.
I haven't read that book, actually. It'd be an interesting one to read. I might get that one from you later. I think it did. I think it's had a major impact on how I think about markets and investing. So it's always been uncertain. In Zimbabwe, it was always uncertain. Inflation, politics, and I think quite early on, I just learned that the best way to kind of navigate through that was to buy really, really good businesses that had to have pricing power, because inflation was such a threat. They had to have strong balance sheets because interest rates were so volatile, and you never knew where they're going. They had to be capital light, because inflation has a really, really bad impact on the capital needs of a business. I think Buffett's described it as a tapeworm. So a lot of people think in inflation, you want to own a business that has a lot of capital. It's exactly the opposite, because as inflation rises, your capital needs go up commensurately. And if you haven't got pricing power, your margins actually start falling. And then always making sure that I own businesses that had, generated a lot of cash flow. So that kind of right from an early age. And then I think the other thing that was so instrumental in those years is that I was quite lucky. I got hold of a portfolio probably, I was relatively young. I was still in my mid to late 20s when I started managing money. I'm probably not qualified for the job. I think I could barely read a balance sheet, to be honest. And I inherited a portfolio of, let's say, 50 shares. And within a year, I'd probably got that down to 10 to 12 really high quality businesses that I felt uncomfortable with. And I've always kind of had that sort of sense of just wanting to own the best businesses and run a really focused portfolio, and then profit from their earnings growth rather than from trading the market. So I think life has always been uncertain for me in markets, because Zimbabwe, then I left there. I actually went to the UK. I mean, once inflation was well into triple digits and we had land invasions in Zimbabwe and the whole political structure was unraveling, and so was the economy. It wasn't a very nice time, actually. And so I decided to go to the UK, and then I landed in the UK literally on 9/11. And so that was a pretty uncertain patch. We're coming off the dot-com bubble. So that was pretty uncertain for a couple of years there. And then we rolled into the GFC, which was, that was a 2 or 3 year hangover of that. And we've had COVID, Brexit, Trump, all sorts of things. And I think Buffett sums this up really well. And it applies, I think, to today, that and the future is always uncertain. And I think the phrase he uses is you pay a high price for a cherry consensus, but uncertainty is the friend of the buyer of long-term value. And I've always believed that you need to kind of lean into uncertainty rather than running away from it.
Just going to take a step back. So when you were running that portfolio of 50 companies and then you cut that down to 10 to 12, was that during your time as a portfolio manager at Bard Asset Management? And
it was. I was working. So I actually moved after about a year or two from money market into asset management. And then I worked it was a subsidiary of Anglo American. And I worked there for 3 or 4 years, I think. And then I moved to Fleming Martin, which was a subsidiary of Fleming's London. Fleming Group in London.
And how did you make that decision to have a high conviction portfolio? Was it through readings or the lessons that you took away from your development, or was there a mentor before?
No, it just seemed to make sense to me that there are only so many hours in the day, and why spend time? Well, there's only so many hours in the day, and there's only so much capital. So why spend your time on inferior businesses, or why spend your capital on poor businesses? It's much like running a business. Any business person tries to focus their capital on their best businesses, and it seemed to me the most obvious thing to do in Zimbabwe as well. I mean, there was also one other constraint, is that a lot of the tail of the portfolio was very illiquid, so you couldn't really build meaningful positions in them. And it wasn't actually, and it was only about a year or two later that I discovered Warren Buffett. And that was, for me, was the real light bulb moment. Like, this really makes sense for me. Focused, quality, long-term investing as opposed to short-term trading. And there's lots of people who can do that. It just wasn't for me.
Yeah. So you spent a good chunk of your career in Africa. So you became CIO at Amara Group, and then you made a decision to move to the UK. So what kind of prompted that decision to move away from your hometown?
Things have become really difficult to live there, to be honest. The political situation had become untenable. Robert Mugabe had, started invading. You had land invasions. Inflation was skyrocketing. I knew people who'd lost their lives, and it just became not a very nice place to be. And much as even today, I still love the country and think they're amazing people there. It's just it was quite instructive to me to get to the UK and kind of go, just that sort of feeling of freedom to live in a country where the police where you weren't actually scared of the police. The police, you could just walk up to a policeman and not be worried they'd arrest you, or free press, things like that. And I just loved that in the UK when I got there. That sort of sense of freedom and a free press, and people could do what they want. The weather was terrible. And then I also loved just being in London and the markets and everything. So that was the main reason I decided to leave.
Yeah, I'm sure Liverpool would have played a part in that, being able to turn up to the games.
I probably wasn't quite as fanatical as I was then. I mean, I'm a little bit of a fair weather supporter. Like this season, I haven't really been following, but I see they're in the hunt. There's only 7 games to go, so now I'll be paying way more attention and getting up in the morning to watch it. It gets really close.
Were there any other countries on your mind when you were tossing up where to go?
But funny enough, Australia had, I don't know why, Australia, ever since I was a young kid, I I remember as a young kid my parents giving me a book and opening this book, and in the book was a picture of the Barrier Reef.
Yeah.
And and I've never been there, amazingly. And ever since I was a young kid, I always had this feeling that I would end up in Australia. So having studied in Australia, I had actually put in papers to immigrate to Australia, but because I had a British passport and I did want to work in London, I kind of think any young person should either live in London or New York. I just think it's just such a, and probably especially London, because you're in Europe, it's just such a it's so good for all your other things that you can learn about, history and politics, and so I always wanted to work in London, but Australia was the other place I considered. My brother lived in South Africa, and I thought, well, South Africa has its own issues as well. States didn't have the sports I wanted to follow, so that was out. So that was probably, it was England or Australia.
So what was the adjustment like in terms of investing for clients in Zimbabwe compared to the UK?
I remember when I got my my first job there, and I was so excited. I mean, it seemed like I was in the big smoke, and I was in London, and I think I was given stocks like Walmart, J&J, and LVMH, and I was just Colgate, some to name a few of them, and I just thought I was kind of like awed. How am I gonna cope with these? But actually, quite quickly, I realized all the principles were the same. The numbers were just a lot bigger. There's a lot more information as well, which was good. But it was quite interesting, because when I got there, we were just kind of coming off the .com, so valuations were still really high. I remember GE used to trade at 50 times earnings, if I remember. Walmart was 40. And but it was the same, just building models, trying to understand the company's competitive advantage. Very soon I realized the principles were exactly the same, just bigger numbers.
Did you ever come across Cisco at the time?
Which one? The tech one or the food one? We used to own the food one.
The tech one.
The tech one. Cisco, I think, was on our watch list. Never ever made it into the portfolios. I think first of all, it was really expensive. I think at the peak of I can't remember what it got to, but at many hundreds of PEs at the peak of the .com. Just an absolute darling. It was quite funny. I think the market cap got to 500 billion, which was considered crazy then, and now we've got 2 trillion market caps. But it was when I've never owned it.
Was that a strong signal or were there any concerns that the market was very overvalued?
Oh no, I was late 90s. In fact, actually, when I was still in Zimbabwe, I was managing money globally as well. Only I was investing in wider Africa, which was really interesting. So you're coming across stocks that were on 3 or 4 times earnings, really good businesses like breweries in Kenya or Botswana that were subsidiaries of global multinationals. The one in Botswana is a subsidiary of South African breweries. And I think the one in Kenya was either a subsidiary of Diageo or Heineken, I can't remember, but really good businesses on 3 or 4 times earnings. But I was also managing money globally for wider African clients, but only in funds. We weren't picking stocks globally, but it was clear to us that this was crazy, the multiples, and you didn't have to be a genius to work it out. But it was difficult because for a couple of years, those clients that were invested globally were kind of going, well, why aren't you buying? I'm trying to remember all the darlings. Cisco was one of them. Yahoo, Amazon. Was that the one from Canada, the telecoms company, Nortel or something like that? So there were so many darling stocks. So we were still coming off the back of that when I got to London. The one I remember particularly was GE on 50 times, which was quite crazy because it was on 50 times, but 60% of their earnings came from financials. So if you put the financials on, say, a bank PE of 10 or 12 times, it was absolutely insane what they were valuing the industrial businesses at.
That's very fascinating. So you decide to move to Australia eventually in 2012, and then interesting.
No, I actually moved to Australia in 2008. Actually, my timing is always good. Every time I move, so when I moved to Zimbabwe, I landed on 9/11. When I moved to Australia, I pretty much landed when Lehman's went bankrupt. So when I'm moving, I'll tell you, give you a good signal for the markets. Best you get out of the market.
So you took up a role as a senior equity analyst, having been a portfolio manager previously at your previous roles. So was there any reason why you took up that position at Evans and Partners in Australia?
I guess what attracted me to the role, Steve Arnold, who's gone off to run his own fund now, we shared exactly the same sort of investment approach. I've always kind of looked at investing as a bit like religion in a way. You got to find what makes sense for you. And so if you're a really quality growth investor and you're going to try and work with a value investor or macro investor or thematic investor, it's just going to be really, really difficult. And so, shared exactly the same investment approach. I really liked the way Evans and Partners still to this day is so client centric. They have some really high quality clients and high quality advisors there. So I really like that side of it. I do like the client interaction. And they would, I felt that was an investment philosophy that would work for me. So that's why I joined in 2012.
And then eventually you've developed and morphed that into Claremont Global. So, which is your current point at this point in time.
Yeah, it's the same strategy. We rebranded it Claremont Global for the external market. We still manage money for Evans and Partners, especially on managed accounts.
Yeah. Okay. And there's some meaning behind the name. Is that right?
There is. So originally we were going to, its genesis, Evans and Partners was the genesis. Its suburb was Jolimont, next to the MCG, if you know Melbourne. When I Googled Jolimont Global, it was a mining company, which I thought was probably inappropriate given we're never going to own a mining stock. So that had to go. And then I looked at Montclair, which was one of my favorite places in Zimbabwe in the Eastern Highlands, where I used to go and play golf. But that was not free, and it had actually become a casino. So I thought that was probably pretty inappropriate. So then we flipped the name around and called it Claremont, which is actually interestingly a suburb in Cape Town. It's a suburb where one of the team members was from. It's a suburb in Perth where I went to university. There's a Claremont in the UK where our head of distribution comes from. And then we also have, we have a Mexican in the team, and we managed to find a Claremont in New Mexico. So and most importantly, the domain name was free.
That's great. That's really, really good to find.
And people told me it sounded vaguely prestigious, so I thought, that's probably a good way to go.
It does sound very nice, and it's great that it's a common connection between everyone in the team, which is good. So outside of investing, do you have any interests that you undertake to get your mind off investing?
I used to play lots of golf, but unfortunately I have a bit of arthritis in the shoulders these days, so that doesn't happen so much these days. I think just going to gym, keeping fit. I like reading a lot, like walking. Those are probably, life's pretty busy with 2 kids, work. So yeah, that's kind of my main pastimes.
Oh, nice. So most of the books that you read, are they for investing purposes, or is it just general? You read anything?
I know I need to read more fiction, and I never read enough fiction. So that tends to fiction is generally holiday reading. When I get a nice thick book, really good book I read over the Christmas holidays, or 2 of them was Wolf Hall by Hilary Mantel, which is really good. It's historical fiction, so that I really like. It's all about Henry VIII. I like books where I kind of just learn something from it. So love biographies, love sporting biographies. Yes, read books on investing. I've just finished reading book on Capital, Story of Long-Term Investment Excellence, which I think I read probably nearly 20 years ago, but I've gone back and reread it, which I think is such a good book on investment management. So those are probably my main interests: biographies, sporting biographies, and then holiday reading is trying to dip into fiction or historical fiction. I also love reading history books, especially when I was younger.
Okay.
But living in the UK, there's just so much history all around you. And I think coming from the colonies, I was very aware of those gaps of knowledge that I had just growing up in Africa and just living in Europe and the UK. Yeah, and I've always been interested in history. That's something else I like reading as well.
I remember going to so many museums when I was traveling around Europe, just nonstop. So it's just limitless.
Yeah, I think it just makes it more interesting when you're actually there.
Yeah.
For some reason, and it's all around you. It just kind of does stimulate the mind somewhat.
So yeah, it's great to get an understanding of your personal life and your personal journey as well. And moving on to the investment philosophy of Claremont Global, it's founded upon the 5 Ps as referred in your investor manual. And the first is people. So the investment manual says the team spends years researching into a business. So a patient temperament is required. Are you able to provide some examples of this in action, from idea generation to actually making it into the portfolio?
Sure. I'll give you a couple of examples. We have something in the portfolio called ROST stores, which is an off-price retailer based in the States. I think I first came across that in the early 2000s. I'd kind of followed it over the years. I never managed to convince the portfolio managers in London at the company I was at, their silo and investment management, which is really high quality growth manager. I could never convince them to buy it. So I think we went to see a store in the States and they were like, geez, this is a dog's breakfast. And that is ROST stores. It's a bit of a treasure hunt experience. So I never managed to get that in the portfolio. And I literally, the first time I got it into the portfolio was 2017. So that was probably a 15-year waiting period. LVMH, I first started covering LVMH when I moved to London in 2001. It was a very different business then. It had quite a lot of debt. I think they'd done quite a lot of acquisitions. But it sort of was on and off. And then I think I started following it more closely, 2012. And we never bought it. I think there were some concerns around the big acquisition of Bulgari, which I got wrong, which turned out to be a fantastic acquisition. And so I basically followed that for years and years and years, and only got it into the portfolio in 2018, December 2018, when the Fed was tapering and the stock came off. And then unfortunately, it went up 50% in 2 months. And so I had to sell it because it had gone well beyond our fair value. And that was traumatic. Anyway, 4 years later, we just bought it again. And the opportunity, we've been following it for another 4 years. And the opportunity came with the unfortunate situation in Ukraine, with the war. The share price went down 15% in a week, and we have our kind of entry price went beneath it. And that's given us an opportunity to own it again. So, I've followed LVMH for 20 years. I followed ROST stores for 20 years. Visa I've followed since they listed, since 2007.
So for that Bulgari acquisition, was it considered to be a big acquisition back then?
It was to be honest, I can't remember exactly. It was, I think what was more the concern, it was big, but they didn't put their balance sheet at risk. It was big, but the acquisition price looked really expensive.
Okay.
But what I got completely wrong is that when LVMH got hold of it, I'm trying to remember, but let's say it was a mid-single digit margin business. It's probably a mid-20s margin business now. And that LVMH would take it to a whole new level. And so actually what looked expensive, once they got margins up to normalized levels, was actually a very good acquisition. And I think Tiffany's will be a similar story. I think Tiffany's has always had a great brand, but they've never really taken the long-term view that management like LVMH do. It's more that American type of company which is trying to make the quarter or make the year, whilst LVMH think in decades and they really invest behind their brand. So I think Tiffany will probably be a similar acquisition for LVMH.
What do you think are the ingredients behind how LVMH really build that high luxury brand that people seem to just keep paying more and more money?
I think, right from the beginning there, it's quite a controversial figure, but Bernard Arnault, he's been there, 40 years. So I think right from the top, and being French, he's always had this, it's more than just a business for him. he sees himself as a guardian of those brands, that they are a symbol of French heritage and history. So I think he takes a really long-term view. Because he takes a long-term view, he really invests behind the brands. I think the other thing I really like about LVMH is that every brand has its own identity. So they go to market with their own distribution, and they have their own identity. So they will use the scale of the group in terms of, finding the best rental locations, in terms of marketing, advertising. They're brilliant at social media. In fact, that's been really, really good for their business. But by the same token, they don't kind of confuse the brand heritages by, having a unified distribution force that goes to market, or, having lots of different brands in the same store. So I think, long-term thinking, obviously they have great brands. So that's a really good place to start. Brands that are hundreds of years old, real aspirational heritage. You can't recreate what they've got. But I think really what it all stems from, there's lots of good brands out there, but I think it is management. Every brand has its own heritage, long-term thinking. I think that's and scale.
Very interesting. Just to flip the tables now, from an analyst perspective in your team, using the time that you take to enter a position, do analysts get frustrated when they try and introduce an idea and put it on your table and it just doesn't make it because they spent so much time researching into it?
Yes. At that level, I'm an analyst as well. So if I want to get a stock onto what we call our approved list, I have to submit it to the other analysts. So there's 4 of us, and if 2 turn it down, then I need to go back and do more work, or the idea is going to get scrubbed. So that can be frustrating, because you've spent, best part of, call it 3 months on it, and that's all you've done for 3 months, and then you get to present it to the team and they go, nah, don't like it. But having said that, it is incredibly interesting work. You have to genuinely be interested in businesses and what makes them tick, and what's their competitive advantage, and what are the people like, and what are their competitors. So I find all of that really interesting anyway. And it's useful work that may be used out, but I think you have to genuinely enjoy businesses as opposed to trading markets. So and then I do want the analysts, if we're the 2 portfolio managers who put the portfolio together, you do want the analysts to be frustrated or pushing hard to get their ideas in, which kind of shows that they have conviction. So, and they're the ones who know probably know that the business is better than we do. So you want them pushing really, really hard. But at the end of the day, if you're an analyst who just wants to flip stocks, and you're not getting stocks in, and you're going to find it frustrating working for us.
I guess the benefit of having such a high threshold is you have a bench of pretty high quality stocks, even though they don't make it into your top 10 or top 15. And it's a matter of following the story and monitoring the performance of the business. Is that right?
Yeah, that's right. You got it pretty much. Approved list is I think it's just under 40 names. I think it's 37 or 38. The portfolio is 14. So, we just keep an eye on that approved list. And then all our work is trying to drive more ideas onto the approved list. And I always think the portfolio is as good as the approved list. Your team is as good as your bench. And so you always want to have a really high quality bench, so that if there is a business in the portfolio you're not quite sure of, that you can switch. And we did that recently, actually. We had Diageo in the portfolio, good business, very good business, but I wouldn't say a great business. And one of the questions we always ask ourselves, what is probably the weakest link in the portfolio? And we felt that Diageo probably was. And then with the Ukraine situation, we got an opportunity to switch from LVMH from Diageo into LVMH at exactly the same multiple, probably nearly a 20% pickup in value. LVMH's, let's say, their organic growth is probably twice what Diageo's is. I think their pricing power is better. And so, what you have to have done is you have to have done the work before the share price starts going down. because once the share price starts going down, if you haven't done the work, you tend to actually move away because you don't know. So that's crucial. You have to do the work before the share price starts moving.
It's that psychological mindset where if you know that a company is a very high quality business, then you want to get at a cheaper price. But then I think generally most people tend to steer away from something where the share price is going down.
Well, it's really interesting. So and this is, you're absolutely right. It's the psychology of it. So if I look at the approved list, and when the share price starts going down, my natural inclination is to want to buy it because I've spent years following it, done the work, we've got an entry price. And so when it goes below that, then I'm however, and this is the endowment effect, anything that I'm not looking at and there's a potential idea for the portfolio and the share price is going down, my immediate psychological reaction is, I probably want to stay away from that. But which is not right. I mean, it's just psychological bias. It's just how we are wired as humans. And all, on the approved list, we see it as opportunity, but on the watch list, we see it as risk. But there's no difference really.
I think the quality of your bench is probably quite similar to the Liverpool bench at the moment. You've got a plethora of strikers.
Yeah, I mean, I don't follow Liverpool that closely to stay. I mean, I'm actually a bit of a rugby tragic, actually. So if you actually look, I support the Springboks, and if you look at their bench, it's probably the best bench in world rugby. It does help to have a good bench.
I'm sure Australia would appreciate having some of those players from that bench. So moving on to the next aspect of the people factor. So you want analysts to put their ego at the door and then put the portfolio and the process the front and center as priorities. Has this ever been an issue at any of the funds that you've managed?
To be honest, no. I think I've always been fortunate to work with people who were rational, had a process. When I worked in London with Silent, we just followed the process. Probably there's more macro, which I've probably when I was younger was more interested in, and I've kind of subsequently experiences taught me I've got no edge at all in macro markets. But you just following the process, buying good businesses, having a target entry price, target exit price. Then at Evans and Partners, same process. Even in Zimbabwe, we had a very similar process. There was a intrinsic value for every business we owned, and we would be looking to buy that at a discount always. So I have been lucky. I've never worked but what I have seen is people come into teams, particularly in London. There was an instance where, let's say, a big personality came into the team, and it was very detrimental to the team stability, morale, process, and eventually that team separated and broke up as a result of it. And that was really instrumental to me in how important getting the right people around the table is, because if one person dominates and sucks all the oxygen out of the room, the quieter, perhaps lesser personalities won't speak up. And they may actually have the exact kernel of information or truth that you're looking for.
So when you say bigger personalities, do you think their confidence and overconfidence, did that lead to poor outcomes for that particular person, or?
To be honest, no. I mean, that was just a situation where and I think there's every investment team has their own culture. I'm not saying our culture is the best. It just works for us. There could be another team where it could be, it's the alpha male or alpha female, hard charging, everyone sharp elbowed, and that's just how they roll. And that probably works for them. Just for our team, that's just not how our personalities are. So I think a big part of it is putting together a team where everyone compensates for everyone else. You might have bulls, you might have bears, you might have good big picture people, you might have people who are good at detail, Just making sure that everyone compensates, because if everyone is all the same person, then there's no balance in the team. And I guess where I learned that probably was most instructive was, if you've ever read The History of Long-Term Capital Management. I don't know if you've ever read that book.
No.
It was have you heard of it, the firm?
No, I haven't actually.
I think it's the book's called the smartest guys in the room.
Smartest guys in the room. That was on Enron?
Was that Enron? Sorry, you're right. That was Enron. I can't remember, but this was the story of long-term capital managers. And I think they had 5 or 7 PhDs, and they were all extremely clever, and they'd won, Nobel prizes for economics, and they were all extremely clever. But the firm went bankrupt because they all thought exactly the same, and so there was arrogance. So there was arrogance, there was hubris, and then there was no balance in the team, and they got it wrong. And they were too arrogant to admit that they had got it wrong, and that was really instructive to me. I saw the same thing happen in the late 90s as well, where people deferred to some of the .com experts, and everyone just kind of deferred to the expert, and that kind of was just instructive to me that you need balance in a team. You always need that one person going, well, what about this? What about that? And it can be frustrating. You're trying to get something into the portfolio, and there's that person going, well, what about this? What about that? But in hindsight, you go, gee, thank God that was brought up. I mean, a couple of years back, I was attracted to looking at Alibaba, and I thought, this is an amazing business model, amazing opportunity. We knew from talking to the luxury brands, how important their distribution was. And in my mind, I was thinking, this is incredible, because for most retailers, you need to lock up the real estate, and Alibaba's locked up the virtual real estate, if you like, in China. But one of my colleagues actually said to me, but we've never been to China, and what are the shareholder protections there, and what is the story with the variable interest rate entity structures? What do we actually own? And the more we dug into that, we thought, and one of the rules I've always thought is a good one is that you shouldn't put money into a business unless you're willing to put your whole portfolio into that business, as if it was your own, there's only business you had. And I remember reading something by Jeff Immelt from GE, and he's saying every time you'd be going to China for 30 years, and he said every time I get on the plane to go home, I realize I know less about China than when I landed. So I think it's you must, and I saw this again. I saw this in Africa, where people would come and invest in Africa from outside, and they just didn't know the nuances of the good managements or the bad managements. They didn't know the political nuances. They didn't know, and so probably that, and that was great. Just the one person in the team who said, I'm not sure, and it's actually so far turned out to be a really good decision. So you do need that kind of balance in a team.
I really like that balanced approach with the formation of your team. I think it's really important to have. So I understand you also speak with ex-employees, suppliers, competitors, industry experts, and management to really understand what makes a company special. Does your team have a particular process or checklist that you use to obtain this information?
Well, we have a template when we put together a new idea. It's called the A-list document, and that's probably 50 or 70 pages. So there's a checklist on that, and you go through that. But I think just generally, when you're in talking to experts, it generally will follow its own line of questioning, if you like. But what we're really looking to try and understand is, how do they think about customers? How do they treat their employees? What's their competitive advantage? Are they long-term? Are they short-term? Are they financially driven? Something that we've owned and I've spoken about a few times is Sherwin-Williams. And that's a company that's based in the Midwest. And it's probably my poster child for just a really simple business with amazing long-term management, incredible culture. And when I first visited them, 2018, I think, I'd follow them. It was actually owned in the portfolio some years back, but I remember sitting down and I asked, it was actually the head of investor relations, something like, what's your what's your company's mission or something like that. And I just wanted to see the answer they said. And he said, our job is to make our customers who are professional painters wealthier and run their business. And I thought that was a really interesting answer. A lot of companies will say something which means nothing. Our job is to create shareholder value, which I find just, what does that mean? And then the way they spoke about their customers and the way, you look at their employees, they have turnover of less than 10%, 7 or 8%, which is incredible in a retailer. And then, the average management tenure is 24 years. The CEO has been there 36 years. And you can just see there's something more than just creating shareholder value. People don't work at that company. I'm sure they get paid, well, and it's competitive, but it was more than that. And that's really, really hard to compete against. Another one in Cleveland is Nordson, a really high quality industrial. And they give 5% of the US pre-tax profits. We haven't known it for a while, but 5% of the US pre-tax profits to charity. So that's like, it just shows you that they obviously, if that's how they treat their communities, they're going to be fair with their customers and fair with their employees and fair with their shareholders. And I think over time, if you've got a good business anyway, and then you attach to that good ethics and good management and good capital allocation, that can be incredibly powerful.
The Sherwin-Williams one is very interesting one.
It's
That's
just
the
paints
one
business. It's literally just a paints business.
Commercial paint, right?
Well, they also, the bulk of the business is selling through their own stores. And that's the other thing I like about that business. You can only buy Sherwin-Williams paint in a Sherwin-Williams store, and it is sold to you by a professional, someone who's actually on a professional relationship. I mean, 10% of the customers are DIY people who want to go to a trade place to buy decent paint. But it's just paint. I mean, the normal growth of that industry is going to be GDP, but Sherwin-Williams has grown at multiples of that. By taking market share and just looking after their customers, building trusted relationships, thinking about the long term.
So they really treated their customers, the professional painters, really well. Did they lift prices back during that time, or was it?
It's interesting business because they are maybe just say slightly slow to take up prices, but even through this current phase of prices going up, they have taken up prices quite aggressively. The whole industry has, because there's been a lot of cost pressures coming through because of logistics, commodity inputs. So that's really come through, and they have taken up prices quite aggressively. But what's interesting is once they do that, and then those cost pressures abate, they don't give price back. Because the price of paint in the job is 10 to 15% of the total cost of any job. So, the main input for any paint job is actually labor. So if you can get save that paint contractor time and make sure you get the right paint, have it available at the right time, you can actually save them a lot of money. If you think of the low turnover of the managers, so call it 6 or 7%. So the average manager has been there 15 years in a store. He's going to know those painters really, really well because they come in every day for a coffee. So now you have this trusted relationship. They remember the goodwill of all the jobs where you saved them. They said, listen, I desperately need this paint. I've got to get this job finished. I'm paying my laborers. They're just sitting around on the site doing nothing. And then you've got this database of all the jobs that you've done for that painter. And when we did our background work, there were, Valspar, they did a merger with Valspar some years ago, and we did an interview with the Valspar employees, and they were all going, we were even offering to deliver paint to these people at cost. We would actually deliver it on site at cost. And they would just say, no, thanks. We've been with Sherwin-Williams for 20 years. We don't change. And that was just really powerful, I thought.
It seems like their customer value proposition was really strong from the early days, and they were able to really lock in those commercial painters. Would you say that the customer value proposition, trying to understand that, is that at the top of the funnel, or is there something else at the top of your funnel, like quick ways for you to really cut out a lot of companies that might not meet your high quality criteria?
I think quick ways always start with the numbers, to be honest. So I'll just look at return on capital, margins. I think gross margin is particularly a key number to look at because it shows the pricing power of the business that you have and the competitive advantage. So if I look at our portfolio today, I think the average gross margin is 56%. Now, the average listed business is 35%. So it's clear we have competitive advantage in pricing power. So, gross margin, returns on invested capital, cash conversion is a key number I look at. And then I'll look at, through time, what's been organic sales growth, stripping out acquisitions and currency. And one of the other things just really quickly to look at is go, okay, if in recession, look at the GFC, look at COVID, and just have a look at the turnover. I'd look more at the turnover than the EBIT and just what happened, how cyclical is that business? And then I'll quickly go and look at the cash flow and go, oh, what happened to the cash flow through that? How resilient were they? Did they have to cut the dividend? Did they have to, issue emergency capital? So those are quick things I look at. That doesn't take long. Okay. And then I try and work out, well, why are those numbers that good? Is this something I can understand? It's kind of like that moment of truth. So I try and think of, if I'm the consumer and I'm buying this product or service, at that moment of truth, is this just a habitual instinctive purchase that I do? Or is this something that I'm very conscious of, and there's lots of opportunities I can switch, and what are the competitors? And then also really just trying to understand if I were given, I think Buffett said this, if you were given a huge unlimited wallet and I started a business from scratch and I wanted to take market share of this business, how easy would it be to do that? And then the other thing I look for is simplicity. I've got to be able to understand the business. And I think that's so powerful if you think, would I be comfortable buying the whole business? And that's why we stay away from complexity, things that are huge parts of the market. That, there's people who can do this. I just can't, banks, resources, oils, pharmaceuticals, biotech, insurers, you need to be a real expert in understanding those businesses. And that's just not for us.
When you say being able to understand businesses, from your point of view, what constitutes an understandable business? Like, is it being able to understand how the business makes money, or is it more so trying to find data points where you can monitor the performance of a business?
Well, I guess there's some form of experience and intuition in it. If I look at and the way I think about it is our portfolio is effectively broken up into 5 divisions, if you like. So in our financial plumbing businesses, we might have something like Visa, or CME, the world's biggest interest rate futures exchange, and also has lots of other equity and commodity indices. When I think of those businesses, it's clear that there's a network effect. There's a network effect. There's an element of brand. There's an element of trust. There's an element of scale. It's very low cost to value. Merchants might argue differently on Visa, but for a consumer, it's incredibly convenient way of paying for things. So it's kind of looking, and I think Michael Porter is very instrumental, and probably one of the best books I've ever read is Joan Margaret's, I think her surname is, Understanding Michael Porter, and just if you understanding competitive advantage, and it is a form of experience and intuition, I guess. And it's not rocket science, this stuff. It's more just around having the discipline to say no. So much of investing is not what you pick, it's what you don't pick. I think it's even more important than what you actually pick. And in football terms that you spoke about, you have teams who win by scoring the most goals, but generally the teams that win the World Cups are the ones who win by making the least mistakes. And that's kind of our investment approach. If we look in business services, we own Aon. Now, something like Aon is really quite a simple business to understand. It's risk broking, it's consultancy, quite a simple business, been around, very long period of time. There's always going to be a need to insure assets and risks. There's always going to be a need for businesses to consult around retirements or talent, pensions. These are very slow changing businesses. It's quite simple to understand. If I think of our branded business, Nike, it's obvious that it's an incredible brand. It's got incredible scale. It's got huge digital insights. It's got an amazing route to market and increasingly controls its distribution. LVMH, we've spoken about. If I look at our healthcare businesses, They're just essentially that they're healthcare services. So we own a business like Steris, which is hospital sterilization. They also do sterilization for medical devices and for pharmaceutical companies. But in essence, it's quite a simple business. A hospital has to sterilize their equipment. Medical devices companies have to sterilize. It's quite simple to understand. It's low cost to value. It's repeat purchase. There's scale involved. So we're kind of always looking for those same sort of things. When we're looking at investment, we have to say, we think the oil price will be this, or if we're looking at a bank stock, we think interest rates will be that, or we think the economy will be this. Experience has just taught me I'm just not very good at that, and I don't like trading businesses based on macro views, trading markets. I feel much more comfortable owning something where I only have to make one decision, and ideally never have that's a one way decision ideally.
It's very interesting to get your view on that, because when I think a lot of people can get carried away with a technical story, and I think people or new analysts probably spend a lot of time trying to learn a very technical industry that might seem very interesting. But it seems like based on your process, you probably save time by not by avoiding a lot of those companies that can get quite technical.
I've made my mistakes over time, Rask. I can tell you, I have owned resource stocks. I remember in the early days, I read a book by Martin Pring, Technical Analysis Explained. I've made macro predictions and got them wrong. I mean, I was genuinely convinced after the GFC we were looking at a Great Depression. It didn't come to pass. I was too bearish through COVID. I thought this was probably GFC Mark II or worse. I've thought for years that the Australian property market's expensive. I think there's and quite often with people, I think this is something people need to think about is compound probabilities. And the best example I can give of that is, I have clients ask me, well, what do you think will happen in the Ukraine war? How long will it go on for? Well, let's say I have a 50% chance of getting that right. And then what's the impact on markets? Well, let's say I've got a 50% chance of getting that right. So 50% to 50%. Well, I've only got a 25% chance of getting the final answer right. If you think of Trump, very few people predicted he would win. I mean, it was probably, let's just say, a 25% probability. But even that 25% people who got the call right on Trump winning, how many then went on to get the call right that the market would rally and would be up 14% per annum through his presidency? So many of these things at a macro level are so hard to predict. One of the things I like to say to people, I think since Google started, there have been 138 meetings of the Fed. And I don't know how much time and energy has been spent analyzing those minutes. What does that nuance of that word mean, or that word, or taper, or easing, or whatever adjective they throw in there? But around the same time, you could have bought Google. It was pretty obvious at the beginning that Google was going, we were very slow. I only really picked up on Google, I think, in 2009. But even so, or you take Google's Sherwin-Williams, Ross Stores, all of these businesses, you didn't take a lot of decisions. See, this is a really high quality business, has a high return on capital. Its earnings are growing well into double digits. It has a good balance sheet. It has a good management. I can buy it at a fair price. So let's just say that multiple holds are bought at a fair multiple, and the earnings can double over 5 years and go up 4 times over 10 years. It's a much easier decision to make than what's in the head of Ben Bernanke or Greenspan and now Jerome Powell or Janet Yellen. That it's just very hard to work out things that are very hard, but it's very seductive. And I still do it. After 27 years, I still do it. I find myself doing it. And fortunately, I have a team around me. We just say you're drifting into macro here. It's just because it's in the media, it's in the newspapers. As analysts, we're expected to have a view, expected to know where the market's going. I have no idea where the market's going. And I've kind of made enough mistakes over time to realize I just don't know.
It's a very good way of explaining it. Compounded probability, just applying it to like a micro level of a company's strategy. It's almost like you probably don't want to invest in a company where its strategy is reliant on so many different factors outside of management's control.
Yeah, I think, I mean, I hate to quote Buffett because everyone does, but I think, anyone starting out, I think he is just the best teacher of basic, good, common sense business. And he always said, buy a business that, I think it's Buffett, could be Peter Lynch, but buy a business that could be run by a monkey, because one day it will be. And so many, if you've got a really, really great business, it can compensate for a lot of economics, recessions, bad management decisions. But if you've got an average business and very bad management or very bad economy, that can be fatal.
Now, you've touched upon the Claremont Global Fund. So it holds around 10 to 15 positions, and you have an investable universe of around 100, with a market cap of generally more than $3 billion. How have you whittled this down to around 100? You alluded to the fact that there's a lot of companies that you avoid, but has that been formed through just going through so many companies over your time?
Well, I guess, yeah. I mean, if you think of the average business we own, it's over 80 years old. So we do like businesses with stable industry structures. They're number one or number two in their industries. They're oligopolies. So they've been around a while. So a lot of them are names I've just followed for 20 years. Occasionally we'll come across something new. We run the screens probably once a month. But we screen by all those metrics that I said to you. So the returns on invested capital, strong balance sheets, market caps. We generally only invest in the US and Europe. There's probably only, if I think about it, there's one company globally I'd like to invest in, which isn't in those two markets. So we generally invest in developed markets, and then we screen out all those industries that I mentioned to you. And that really quickly whittles our list down probably to 200, 250 names. And then there's a whole lot we can also scrub through there, and that gets us to a watch list of 100 to 120. And the way I think about it is, if you were running, let's say you were running your own business, and let's say you had your own contracting business, paint contracting business, and there'd be a whole lot of businesses around you, you would think, I'd like to buy those in time. And then you know what they're worth, the people who run them, and then that can be years following them. You don't have to follow the whole world, I don't think, because it increases so much complexity. So if we've got 15 stocks, and let's say we trade one a quarter, well, we only have to find 4 new ideas a year. And we've already got a bench sitting behind the portfolio of 25 names, so we can take 4 from that 25, and then every year we kind of refresh that approved list. So ideally, if we don't trade at all, that's the best, because then there's no trading costs and there's no tax implications. But that works for me, and I guess we're only trying to get 8 to 12% per annum. So there's other investors out there who want to get 15% or 20%, and so you have to be more aggressive. But obviously, the more aggressive you are, it works both on the upside and the downside.
So in terms of the companies that you do focus on, it seems like organic growth plays a big role or it's an important characteristic that your companies possess. So what kind of growth strategy provides the most value based on the most successful investments to date?
Well, I mean, ideally, you want volume growth. That's straight volume growth. You don't want companies can't just be putting up their prices. I quite like business. If I can find a business that's got volume growth and then putting up its prices in line with inflation or slightly ahead, I'm kind of comfortable with that. I mean, something like LVMH has consistently put their prices up ahead of inflation over years. It seems the more they put up their prices, the more people want what they sell. I mean, it's classic Giffen good. But yeah, if you want volume growth. But when we say we're looking for organic growth, it doesn't have to be what I call go-go growth, just faster than nominal GDP growth, because even something like Aon, it only grows its top line at 4 or 5% over the cycle. I mean, last year, I think it was 9%, it was very strong. This year is probably going to be high single digits again. But normally, if you can just grow your earnings at your top line at 4 or 5%, grow your expenses in line with inflation. And then you've got a very capital light business, something like Aon, which is generating a huge amount of cash, and they buy back 3 or 4% of their stock every year. Quite quickly that gets you into low double-digit earnings. But if your valuation, but we have businesses that are 4 or 5% organic growth stories, something like Aon. But then we'll go the whole way up to something like a Visa or an Alphabet, which is low teens to mid-teens growth on the top line through the cycle. But what's really most important for us is not the rate of the growth; it's actually the predictability of the earnings in 5 years. That's what we're really interested in. 3 to 5 years out, do we feel we got a good handle on what this company is going to be earning, and do we have a good handle on how management are going to allocate capital and how they will maintain competitive advantage?
So in terms of predictability is it certain, like the overall aspects of the business, the operational aspects, trying to understand all the different cycles that the business goes through, that provides you with confidence in trying to forecast earnings. Is that right?
That's pretty much it. Yeah. So when we look at a business, we look backwards first. They look back 10 to 15 years, at least go back through a really serious cycle. And the GFC, as I said, is a good cycle to look at. So if you've got a business that's weathered a lot of cycles, that does give you confidence that they don't have high operating leverage, high fixed costs, they lack pricing power, they have weak cash flow, weak balance sheet, or whatever flaw or weakness they have in their business model. If they've weathered those storms successfully, that does give you confidence that, and when you do forecasts, I mean, analyst forecasts are notoriously, inaccurate. So, you've got to make sure that you forecast. I mean, no one's analyst model ever has a recession in. So you got to try and forecast businesses that that you have at least a shot of getting that earnings track trajectory right. So like banks, it's almost impossible because you have to forecast the economy. I don't know what's going to happen. You have to forecast interest rates. Oil prices, the one I love with oil prices, 2014, when oil prices were well over $100, and every oil company, every oil expert, every government body said oil prices are going to stay above $100 forever. And then shale oil came along, and very quickly the oil prices were down 50 or 70%. And not one of the experts, well, I'm sure they were experts, but I never saw anyone say that was going to happen. In 2007, no one would have predicted that interest rates would be this low, with budget deficits this high, with inflation this high, with money creation this high. It was almost inconceivable. So if your whole business rationale is based on making a correct forecast of a macro input or a commodity input or a drug discovery or a government regulation or a political election, it gets really difficult.
I just wanted to peel back a few layers about your comment in preferring organic growth where it's growth through volume. So with companies like Aon and LVMH, are you trying to understand the total addressable market, how much it can grow through its existing customers and also through market share?
In some instances, we'll do that. Most cases, we'll look at what's the company's organic growth been over time. So it gets more, the faster growing businesses, we kind of scale down as they grow through time and sort of almost trend back to nominal GDP growth through time. So they're kind of growing quickly now, but we know there's going to be no businesses can grow faster than the economy for a long period of time. There are certain businesses we'll look at and we'll go, I mean, you can look at something like Visa and you can look at what the addressable market is, and called PCE in the world is $50 trillion. As it stands today, I think 25 trillion is done by card. So you still got that. That that 50 trillion is growing, call it 4 or 5% every year. There's a whole lot of new uses that are found for cards all the time. There's uses 10 years ago we couldn't have imagined, P2P, business to consumer, government to consumer, B2B. The flows now are two ways. In the early days, it was credit cards, and that was a lend model by the banks. Then it became debit cards. That was a spend model. And now it's just become a way of just moving money around. You can move from a card to a bank account, from a card to a bank, from account to account. So all the nodes of moving money there's just more and more. So in that sort of instance, you can see, I remember when I first, saw the card companies, you could see such a long runway of growth. because you had this huge addressable TAM. You could see what percent was done in cards. And so there are instances, there's another business we're looking at the moment, which is a software business, and we can see how big the TAM is. I think it's something like $70 billion, and only 30% is third-party software. So that type of business, you can actually see the long runway. Something like Aon, it's not going to grow much faster than the economy. I mean, at the end of the day, it's a very steady state business. So it's normally the high single digit 10% plus growers where you're kind of looking at the TAM and seeing how far they could potentially go. But most of the businesses that we own, I mean, Alphabet back in the day was another one where you could look at it and go, well, how much of the world's media spend is on this rubbish, linear TV programming and print and magazines. And you didn't have to be a rocket science to work out that all of those ad dollars were going to shift across to where the eyeballs were. And you could see, look at the spend. So those types of businesses, you can look at market share, but something like Aon, we know it's just going to grow in line with nominal GDP or maybe slightly faster. So there we don't kind of look at the addressable market is global GDP effectively.
Just all that software TAM, would you verify that yourself and just double check whether or not it actually makes sense?
Yeah, so that there we'll use, in our expert calls and stuff, we will speak to people and, who've either been in that industry or compete with them and say, but there's normally what happens is you can actually see evidence of it happening. So we wouldn't make an investment going, okay, well, it hasn't happened in the past, but it's going to happen in the future. We will more often than not will wait for it to start happening and then jump on, because normally these things have a really long runway. So we tend to be slightly late to things because I'd rather jump on slightly later, pay a higher price, but the probabilities of it working out being much higher. There's a reason that venture capitalists have hundreds of positions. Lots of them don't work out, but then you have the one that really works. We're the exact opposite. We want all our positions to work out. We can't have any failures with only 10 to 15 stocks. So that one you're talking about, you can see for years, if you go back and look through all their presentations, you can see incremental market share gains over time. You can see that with Visa. You can see that with Alphabet. Something like Aon, it's a 4 or 5% grower.
So you want to partner with management teams with a resolute focus on a company's core competitive advantage. So what do you mean by this, and what are the signs or indicators are you looking for when you evaluate management?
The key one is capital allocation. Capital allocation, and also how they talk in their transcripts, or when you talk to them, how do they talk about do they understand what makes the business special, and do they understand strategy? And a lot of the stuff's actually, it's pretty basic, but what ends up happening is you get a lot of people think growth is a strategy. So if you ask a management team, we just want to grow, but that's not a strategy. The strategy is defined by what you won't do. What type of the market are you going to go for, and what are you going to do better than anyone else that's going to make it difficult for customers to switch? So what you see often is that you have these really good businesses, they generate a lot of cash flow. And what I say, often management confuse their own brilliance with the company's competitive advantage. So they'll get to quite often, people who get to running companies are not shrinking violets. They're probably, hard charging, aggressive people. They get to the top of the company and they go, right, I'm really going to make my mark and I'm going to grow. And that means, okay, well, let's go to make acquisitions. And what ends up happening is what they do is they take the money from the special core and they divert their capital and their attention into something that at the time looks really exciting. An investment banker turned up and gave you a great PowerPoint presentation. You have to do this, it's strategic, whatever reason there is. And it's just so tempting to do it. And what I find always fascinating is a company is only interesting, it's suddenly in play when someone else wants to buy it. So yesterday I didn't want to buy the company, but now my competitor wants to buy it, so now I have to buy it as well. But you weren't interested in yesterday. We've seen an instance in Australia where Woolworths has had a really long history of doing a very good job in retail, and just at the time when competition was heating up from Coles and from Aldi, they decided to go into DIY where they had no pedigree at all, and they went up against Bunnings, which is an incredible business, who have the best sites, who have the scale, who have the management experience, best relationships with suppliers, best people, and it ended in disaster. And it's not surprising. GE, classic example of a really good industrial business that took all that cash flow and ended up becoming effectively a financial conglomerate that went into property and insurance and media, movies. They shouldn't be in those businesses at all. What they should have been doing is taking that cash, reinvesting back in the business, reinvesting in R&D, making better products, listening to their customers. And if they had done that to the best of their ability, then they'd give the money back to us shareholders, buy their stock or give us dividends. But it's just managements can't help themselves because there's always this pressure from the shareholders to grow, and there's pressure from the employees to grow. And the investment bankers are in the boardroom saying you need to make this acquisition, or then 5 years later they'll turn up and say, oh, you need to break up the company, and on it goes.
Interesting that you mentioned how Woolworths tried to start Masters to battle against Bunnings, and I think Bunnings did a similar thing in trying to enter the UK market.
Bunnings did exactly the same. I mean, Australian banks have been to the UK. It's not, I don't like to call out people, because, but there are examples. Those are examples I would give. I mean, fortunately, Woolworths now is right back on its core business again, and that's been really, the business is doing much better. Or Bunnings is right back on its core business. I mean, Australian banks, they went to the UK. Tesco's is a good example. Tesco's went up into the States, and they're going to go head to head with Walmart. That's not good, and it didn't end well. I mean, they also in the late sort of noughties, they were expanding all over the world, and all you could see is the return on capital kept falling all the time. The earnings per share was going up with lots of sort of accounting gymnastics, but the return on capital was falling all the time. Just at the time, again, in the UK, when Sainsbury's was going through a renaissance, Aldi, Lidl were coming at them, and what they should have been doing is just focusing on the core. And it's kind of similar to military strategy if you think about it. Like you end up fighting wars on lots of different fronts. It just gets really, and you just divert all your resources. And if you're fighting against someone who's got all their resources focused on one area, it's very difficult to. And there's so many instances of European generals or people who went and opened up. The normal one is going to take on, expanding east, and that normally doesn't end very well. Or even think of the Romans. They just got too big, got too far dispersed, and eventually just got overran.
It's great to hear historical lessons where they're so relevant to business as well. In terms of over a long period of time, you've been monitoring the performance of these management teams based on the capital allocation decisions. Have there been any management teams where at first, in the first 10 years or so, they've done really well, but then it started to wane, and then you've potentially lost confidence or faith in them making future capital allocation decisions?
Good question. I'm sure they are, and I'm sort of, I mean, a good one actually that's quite topical at the moment. It's something we looked at last year quite closely is Facebook. We already have a very big position in Alphabet, but Facebook itself is a pretty impressive business as well. Very strong position in digital advertising, great financial metrics, high margins, great balance sheet, great cash flows, owner managed. So lots of things we like, but the reason there are a couple of things we don't like. We didn't really like the governance and the kind of ESG position. That was a negative. We felt that the owner had just basically, there was not enough checks and balances, on him. We didn't feel they put consumers' interests, first and foremost. It's interesting on the expert calls when we did experts with ex-Facebook employees, they kind of, the tone coming out was just kind of build it and sort out the problems later. Whilst if you spoke to ex-Google employees, the tone coming out was, we will, what we'll do is we kind of move really slowly, and we kind of have to reach, and there's problems with that as well, bureaucracy. We move slowly, but then when everyone's got buy-in, then we move really, really quickly. But we do kind of think, they just seem to think a little more around consumers. But when Facebook then suddenly said, and it may work out, I'm not saying it won't work out, but suddenly they changed the name and call it, what is it called now? Meta Platforms. Meta, and then they just, their whole suddenly strategy is all going to be metaverse. That's like a whole new kettle of fish now. You've taken your capital allocation to focusing on the core business, but you feel that's getting disrupted. So now we're just going to, and it's kind of just the odds just change because now it may or may not work, but now we're kind of more into venture capital, and then we're having to make a prediction on the future, and so we feel much less uncomfortable about that. I'm trying to think of, big acquisitions are normally the big thing that always is more often than not a disaster, and I'm trying to think of some in my own mind. I mean, but I can't. But I'm sure they're there. They will definitely be there. If I go down my list, things that we've pushed onto the B list, but I can't think of any at the moment.
No worries. I think that was a great example, and it's a very relevant example today. So just moving away from management, I'd like to talk a bit about valuation. So the investor manual says it's based on simple metrics, which is based on it's empirically based. So it'd be great if you could expand on a couple of those simple metrics and what the empirical reasoning was behind each one of them.
Well, I guess when I got my CFA, especially armed with my CFA and finance theory, so looked at DCFs and WACCs and all that type of stuff, and I guess what I found over time is that you could make the valuation be anything you want it to be by just change. And I've seen sell-side analysts do this as well, by changing your discount rate, changing your beta, changing your WACC, changing your terminal growth rate. You can make the valuation do whatever you want, especially at low interest rates. So that's, the most traditional measure is using using a DCF. So we don't we use a backup DCF, but it's very, very back of the envelope, and it's just a sense check. So really what we look to do is we say, okay, because we look at forward earnings, and so we say, well, what do we think this business can earn in 5 years? What sort of multiple would we put on those earnings? And then we just discount that back at a constant discount rate of 8%. And that gives us, effectively, that's the purest return an investor can receive. And that's how we do it. And it's really just a series of IRRs that are running through the portfolio. I mean, I've seen people use trailing earnings. There's a benefit to that, in that you don't have to do the forecasting. So there's a positive in that. But what we're really interested in is the future, and what is this company going to be earning in the future. But you have to pick businesses where you have a really high degree of confidence in those future earnings. And it's that simple. And then we use through the cycle inputs. So every sort of multiple we put on earnings, we don't kind of look at today's multiple and then say that's a fair multiple. We'll look at what does this business trade at over 10 years. What's a normal multiple? And then over time you get a feel. You know that Aon's going to tend to trade at a market multiple or a 10% premium. Visa's a 50% premium. Alphabet's a 35. Something like Estée Lauder. You kind of get a feel, where do these businesses normally trade relative to market multiples. We generally don't buy businesses that trade at a discount, but it's not very not going to win any awards at universities, finance courses, I don't think. And it's just something that's how I learned how to do it in London with Silo and investment management. And that's kind of, I've seen other people do trailing cash flows. There's benefits to that. I've seen people do, I think DCFs, I'm definitely not a fan of a DCF because the inputs can make the final number be very volatile.
So when you build those earnings, are you trying to forecast the earnings over a 10-year period?
5 years.
5 years. Okay. And selecting that multiple.
10 years. 10 years is a really long time.
Yeah.
I mean, and the way I think about this is, if you think back 10 years ago, the one that's been really interesting for me has been the whole demise of that kind of mass media consumer staples space. So 10, 15 years ago, these were the alphabets and Visas of today. They were the stocks you had to own. 40%, I think, of our portfolio was consumer staples. Things like Colgate, Gillette, Procter & Gamble. And just over time, those companies have seen their competitive advantage slip. They've seen their growth rates drop. More and more competition from private label. Their competitive advantage they've had in mass media has been, changed because of the way you can get to market very cheaply now through the internet. So businesses change. So 10 years is a long time. But then, as I said, the average age of the businesses we own is 80 years old.
Yeah. So for those kind of industries in the consumer staples business, would you put on a slightly lower multiple than you would usually?
We wouldn't even try and value them.
Yeah.
So what we always start with the quality piece.
Yeah.
So what we don't try and do is adjust for risk. I mean, my previous job in London, we tried to do this, and we used different discount rates, and we had an A, B, and C list, and A's got a lower discount rate, and we adjusted for beta. And in the end, I've just kind of got to this where I just go, you know what, I want to earn 8%, and I want to earn it owning at least. I don't try and adjust for the risk. If I had a 50 or 100 stock portfolio, maybe I would have some more risky positions and have a higher discount rate to adjust for the risk, which is traditional finance theory, which is correct. But we don't do that. So Colgate's not even on our watch list now. In fact, there's very few consumer staples on our watch list.
So arriving at that multiple, is it an industry specific multiple where you try and work it out? It
tends to be stock specific, actually, but it's stock specific, but it tends to be industry specific as well. So for some reason, we know that Aon is never going to trade at a big premium to the market. The market treats it as an insurer. Even something like Alphabet never, and why we've owned it for 5 years, it never really gets a very high multiple. The market quite rightly is and it's actually interesting. A lot of businesses that are faster growing, the market's actually quite good at actually handicapping that, because as soon as you got faster growth, your predictability just by definition is going to go down. Because your range of outcomes is going to be much wider. So quite often you'll find that businesses are really fast growing. I mean, Amazon's a complete different case, but something like an Alphabet has never really got a very big multiple, while something like a Estee Lauder, which just every single year is a 6-7% organic growth, makes its numbers. The market will pay a high multiple for the predictability. L'Oreal's another one, so I just don't want to get into an argument. I think the market does a good job of working out over time, what the appropriate multiple is to put on earnings.
What would you assess, like the current multiple? Would you assess the performance of the business, like historically, and then you try and work out the relevant multiple now? Like,
there's an element of judgment in it. So I mean, a big part of it is going, well, where does this business normally trade? What's a normal multiple of earnings to put it on, using a 10-year average? But then, there will be instances where a business might have had a really high multiple, it's super fast growing. Amazon, it's on our watch list. We've never bought it because of valuation. There's also, we've got probably, we've got Alphabet and Microsoft, so there's no need to double up there. So we would never use the past multiple as a guide to the future once it gets into a more steady state type. Sometimes you have really fast growing retailers, in time that growth rate will drop. So you have to kind of say, okay, in 5 years time, what do we think the multiple will roughly be? You'll have other businesses where we take the multiple up, where you can go, the competitive position's actually improving, but we can only we kind of have rules, how much we can go up and how go down, because the way we're wired as investors is company will have a result. You feel really good about the result. You upgrade your numbers, you upgrade your multiple. Same thing, you have bad result, you take your numbers down, you downgrade. And it's the recency bias. It always feels, and even the businesses we own, it feels like Alphabet's forever or Visa's forever. But, if I look at those businesses, even as exciting as they are now, they may not be forever. I thought Colgate was forever. People thought GE was forever. Nothing's forever. Well, Sherwin-Williams maybe, but.
So you noted in your investment manual, you're saying that European and Aussie companies tend to trade on a premium compared to the US stocks, and you say it's a function of scarcity value. Can you elaborate on this and what you mean by this?
Well, it's just so if I'm always amazed that the macro strategists always say sell the US, it's expensive, buy Europe and Japan because they're cheap. But if you actually look at a stock quality growth level consistently, and I found this for 20 years, the US more often than not will be cheaper than its European counterpart. And if you look at the Australian quality growth names, you look at the CSLs, the ResMeds, the Cochlears, I mean, they will trade sometimes 20 or 30 points above what you will find in the States for exactly the same sort of financial metrics and growth. And it can only be because of scarcity value. There's no other reason that explains it to me. There are just so many good businesses in America. It's just a deep market and your choices are much wider. That's the only way I can explain it. Because it just makes no sense to me. If you were a rational business person, why would you buy CSL in Australia when you could go and buy something equivalent in the States at much, much cheaper? But obviously, as an investor, an Australian investor, you have to own all of these high quality Australian businesses. And then that goes to the institutional imperative. I've got to be on the benchmark. I've got to own the best companies. If I don't, I'll lag. If I lag, then I get fired. But we only have to own 10 to 15 quality growth businesses. And I've always skewed to the US. And it's not because of the macro. It's not because of the politics. It's just where we find the best businesses.
I feel like a lot of those big names in the ASX market, the CSLs and the ResMeds, probably maintain that multiple because of the reasons.
They probably will. Yeah, they probably will. But I guess the risk is, as a global investor, and we have this actually with some of our, there's a Danish company we follow, a terrific business, and it consistently trades at a really high multiple, and we'd love to own it. But there's always, you kind of go, well, that just doesn't make sense to me that it trades at that multiple. And so, we handicap that and go, I know the analyst gets really frustrated by that, and he's probably right. But there's always the risk, you go, well, why can't I just go and find something else where I just don't have to pay as much?
Because there's more, I guess, more downside risk with owning those companies.
Exactly.
Yeah. That was great to talk about people and the process behind the overall Claremont Global investing philosophy. And now on a portfolio level, you did refer to a couple of business risks and companies that you prefer to avoid. Now, there was one that particularly interested me. It was companies that were generating profits in decline due to a structural decline as a result of a fade in their competitive advantage. How do you monitor this and keep a pulse on that?
Normally a good place to start is you're going to get declining organic growth. And then the next thing that kind of happens, you sort of see margins slipping, and because margins are slipping, they'll start using adjusted numbers. And then they will probably embark on a cost-cutting exercise to get those margins back up. Another one you'll see is he's kind of struggling, so they then start buying back their stock very aggressively, gearing up the balance sheet to try and, it's what I call the pear-shaped income statement. No top-line growth, cost-cutting through the middle of the income statement, and then buybacks aggressively, and hey presto, we're a double-digit grower. Other times you'll see them, they go, we can go for the major acquisition to kind of hide the declining organic. It normally starts with organic growth, to be honest, and margin slippage. And the market's actually quite good at picking up on this. And so then what ends up happening is that the multiple compresses on you. And then as investors, we kind of have to go, and my co-PM and I, we kind of go, well, if this is in the portfolio, it's obviously cheap. We should be buying more of it. But if we can't kind of bring ourselves to buy more, we'll get out of it, because we obviously haven't got much conviction in it. And I think to be honest, I've made mistakes like this in my own personal portfolio. I've only got a couple of investments outside the fund, but it's so good to have the process and stick to it and be it's so easy for investors to slip into the type of thinking of, it's only a small position. I'll try and get back to what it was worth. Get back to break even, or it's too cheap to sell, or whatever it is. And I kind of just learned over time, it's easier just to get out of that position and put in something that you actually have conviction. You don't have to make the money back the same way you lost it. So you should come to work with a blank sheet every day and go, if I didn't own this, would I buy it today?
It's a very measured approach. I really appreciate it and really like that. Just moving away from all maybe the more investing side of things, and then onto your personality and the traits. Now, I've noticed some of your previous colleagues have described you as dependable, conscientious, courteous, knowledgeable, and an excellent communicator. Were you born with these traits and attitudes, or did you spend a lot of time honing on these?
It's good to see the bribery money is working. I mean, I don't know. It's a hard question to answer. I think I've always been a reasonable communicator. I've always been interested in businesses, so I don't kind of look at it as work. I just find it interesting, reading annual reports or reading transcripts, or I don't know if it comes from sport. I love the idea of competitive advantage and being in businesses. It's like watching a really great sports team and just going, these businesses are just so powerful and have competitive advantage and excellence. So I don't look at it as kind of work. I've always thought that in investing, I think it is important to be, what's the word? Even with the companies you interview, just be polite with management. It's actually, you can ask all the questions you want, but just ask them in a polite way. It's not easy running some of these big conglomerates. I couldn't do it. And you're probably going to get better information out of people by just being polite and not
empathetic.
Not empathic. Just if you treat people, if you're aggressive with management, they're going to go, oh geez, that guy's just aggressive. Just don't take his call, or don't, we've got a difficult job. They've got a difficult job. Our job's to ask them questions they may be uncomfortable with, but you don't have to be aggressive about it. And actually I fell into this mistake, to be honest. In my early years, I would stand up at AGMs and I would ask the aggressive question. It was really about me. What was really about me, and going, here I am, everyone, I'm asking a big, and over time I learned that didn't really get me anywhere. I mean, I've never been a sell-side analyst. So as sell-side analyst, you have to probably be more outspoken. Luckily on the buy side, you can just make your own opinions. I think within a team, it's really important to be respectful of other people's opinions, because if you're aggressive, again, like I was saying, you can suck the oxygen out of a room. And it just helps other people to play to their strengths if they're not kind of living in fear, if you like. I think I've probably always enjoyed reading and communicating, I guess, writing, or especially talking, as you see by today. I've waffled on. Just love explaining to clients. I think so much of investing is made complicated. It's actually if you just change the word from investing to business, then it simplifies things. There's a whole lot of complication that's grown up around investment, which more often than not is very advantageous to the people selling it and very disadvantageous to the clients who buy it.
It's a very balanced approach. I think it reflects what your previous colleagues have said about you. Reflecting on what your colleagues have said, and do you try and find analysts that kind of possess the same qualities and attitudes that you have?
I guess, yeah. No, if you look at our investment team, it's a small one. There's just 4 of us, or even if you look at the whole team, there's just 6 of us. I mean, every single one of them is a nice person. I mean, it's a cliche, but they're respectful. They're respectful of clients. They're respectful of colleagues. We're all human. We all know we're going to make mistakes. So you need to have someone next to you. I remember one of the great things someone told me. He was in a London Philharmonic Orchestra, and he played the oboe in the orchestra. And I said to him, "So you're on tour. How does the orchestra work? It's got to work like a team." And he said, "What's really important is that the whole orchestra, that people actually get on and like each other." Because he said, if you're having a bad night and you're playing off key, you need someone next to you who has the confidence to say to you, "You were terrible tonight. I'm just telling you that." And so I think, that sort of collegiality, but that works for me. It might not work for other people. I'm just saying, for me, that works. So I think that's important. I think people who genuinely put client interests first is really important. What we do is actually quite a serious job. I mean, it kind of gets lost in the glamour of markets and blah, 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 and rockstar fund managers and all the rest of it. But it's actually really important what we do. I mean, this is people's retirements, it's kids getting educated, it's elderly people sleeping well at night, it's transferring wealth to the next generation. It's all sorts of these things. So it is important what we do. And so I look for people who realize that just not in this industry because they just want to get paid lots and lots of money, because it can be financially very rewarding. So that's important. I think people who are curious. I think people, and so like if you look at our team, we have lots of different backgrounds and nationalities, and I like that. I think people who are immigrants are generally, maybe because I'm one, I have a predisposition to that, because you're bringing different life experiences, different kind of different life experiences. You naturally, as an immigrant, you want to prove yourself. I won't mention him, but he's a very famous Australian investor, and he said something that really resonated with me. He said one of the disadvantages of people who went to some of the elite Australian private schools is that they're all still talking to those same people 20 or 30 years later. So they haven't developed, and they're always still competing with those people. They haven't developed other sources of life experiences or knowledge, and that really kind of stuck with me. And he was an immigrant as well. So I think that's an interesting trait to have. Patience is really important. Like I said, you have to genuinely enjoy investing. And then you have to, in our team, you have to be a team player, because there'll be times when you go, I'm sorry, or you want that analyst not over championing their idea to the detriment of everyone else's. So just, or keeping all their IP to themselves and not sharing it with the team. Just because if I get a good stock in the portfolio, I'm going to get a bigger bonus. But that's going to be the detriment of the portfolio and the detriment of clients.
It's very important characteristics, attitudes, so traits for, I think, anyone to have, whether it be investing or...
Just an anecdote, one great story, a sporting analogy that I love is, and having been a fan of the Springboks, is, John Smith won the World Cup with the Springboks in 2007. And he said in his book, there was this player who's clearly the best player in South Africa at the time. And he went to John Smith and he said, you know what, look at my stats, look at my tries scored, look at everything here. I'm clearly the best player in the country. Why am I not in the team? And John Smith said to him, well, what are the names of such and such as kids? And he said, I don't know. He said, that's why you're not in the team. And that, that type of, you want people who kind of all driving towards the same place.
It's a very profound anecdote. And I think that leads into a very profound question. And it's a question that I ask all my guests. So who's had the most influence on your development as a person and investor, and why?
People I know, or books, or people. Definitely people that I've worked with.
Yeah, anyone.
I think definitely working with Seiler Investment Management in London, Peter Seiler and Michael Boyd. Yeah. Definitely, Peter kind of really honed in me the quality growth philosophy, focused quality growth, long-term investing. Michael Boyd as well. Michael Boyd was, he's gone on to form a very successful company of his own called GuardCap. Just really the way he ran the team, very calm, no ego, just a really, just a very, very, very smart, decent person. I'm not surprised he's been as successful as he has been. I think working with Stephen Arnold, he had big influence on my thinking in terms of just forgetting about macro analysis and just throwing that out the door. I think that was, working with Steve, I think was very instrumental. And those are the people I've kind of worked with. I haven't had a lot of jobs in my career, but those would probably be the key influences.
That's a number of great role models that you had in your life. And I think that's a reflection of who you are today. I think after listening to your story, how you built the team and what you look for in individuals when they do be part of your team. You're very generous with sharing a lot of your time as well. So really appreciate you coming on the Australian Investors Podcast. I think you're a great role model in the Australian investing community. So thank you, Bob.
Thanks, Ray, and thanks for your time. And I hope your viewers hope they find it useful.
Thanks, Bob. Take care.
Ray. Cheers.